Dan. The types of syndicates being formed in Silicon Valley, you touched on it briefly before. Organized, unorganized?
Totally unorganized. Okay, so unorganized from what I've seen, the maturity, like I got to meet my East Coast angel family last night from the First Angel Network. And that was, from what I've seen, that group has done some amazing stuff. And then I kind of balance, I pattern match that against what I'm seeing in San Francisco. I went to, you know, I learned everything I've done from an investment point of view, either doing it initially for the first 2 years and over the last year by really talented, probably some of the best angel investors in the world. And it was, I went to this conference at Y Combinator called AngelSoft, and that's where I learned you have to be okay with what you just said, James, is that 80% or 90% of the time I'm going to be wrong. Like, what a weird business to be in where you know you're going to make the wrong decision 90% of it. So I was like, okay, I can deal with that. I like risk. And then the other thing is they talked about how do you actually, if you're going to lead around, how do you become attractive to other investors, and or how do you get deal flow from other investors? So it's very informal, and you can create the top 25, you know, personal, you know, business angel list, and you know, that's what I did. Much like if I was doing biz dev at a startup company, I started calling on them and saying, here's my value proposition, here's what I do for entrepreneurs. I've asked other entrepreneurs to say good things, and it was really, you know, a sales process to start getting deal flow from these other angels. And it's totally different than what I've seen in organized groups. But at the same time, the quality of those deals have been ridiculous. I mean, probably some of the best companies, very early, very interesting, super smart, and I think that to me is, you know, one strategy, and the other way is to do, and what I'm going to start exploring over the next couple of years is more these syndicates through groups of angels. So I'm excited.
Good. I guess you've touched on it a bit. The issue of alignment between, you know, within an angel syndicate with your next level of next round of investment with institutions. You know, aside from the one point that you mentioned on, you know, having enough capital to deploy over the life of the investment, so you don't get, you know, wedged into you know, a bad situation. What other areas do you find important on the alignment front between the group of angels and that next round of institutional investors you might want to be going after?
Yeah, well, and again, I will take over to amend. It's not necessarily the next round. It may be the same round. In fact, often Common Angels is leading around with an institutional venture capital firm as either the co-lead or follower. And this is particularly true of smaller venture firms who have more money than we do, but far less bandwidth. And we bring well-organized expertise and meaningful capital. It's a huge value proposition to them. But yeah, let's hit on the negatives, couple quick negatives that we've learned in New England syndication, and then the positives. So the negatives, and those of you who've been through syndication processes, either as angels, individual investors, or through your other efforts in the financial world or just in business, know that there are really sort of two sort of dynamics that happen, two negative dynamics that happen in syndication. One is a propensity to keep the apparent good deals to yourself. And you see this when people, oh, I got this hot deal. Oh, no, you can't have it. No, I'm going to go to client. I'm getting Sequoia. You can't. Please. You know, first of all, you know, the idea that they might invest in your deal, even if they did, is that a good thing for you? Back to this issue of alignment of incentives. Why do you want to be Sequoia's call option? And not to pick on them, but they and Kleiner Perkins, those of you who've seen the statistics, invest in something like 300 to 400 different deals over the course of a fund or so. And they have the highest failure rates in Silicon Valley. They also have one of the highest success rates. I call that triage. Lots and lots of little investments and then winnowing that field. I think it's a legitimate investment strategy, it's just not mine. And why would I pick someone who would co-invest with that? So a propensity to keep your good deals to yourself, or, oh, you know, I know I'll get the money later. I'm not going to allow syndicate partners to come in and have me as an investor face dilution. Oops, October comes. Where's that money? So that's a big mistake. The other is the obverse, which is playing old maid. And that says, I know this company's a loser. But if we could just get a little more company to shore it up, right? You can pull that one once or twice, but you really, as an investor, are known by the companies that you work with. And you know, there are certain organizations in New England that always seem to bring the strugglers. And we have screening, and we say, oh, whose deal is this? Oh, okay, we know whose that is. You know, it's not a signal that you want to send. On the positive side, the first and foremost rule is the role of the lead investor and understanding and appreciating what a good lead investor is. And a good lead investor is what I call an active outsider. There's someone who doesn't step in for the company, does not act on behalf of the CEO, although I have been known to cross that line once or twice and need to pull myself back. But your access as an investor is disproportionate to the capital markets, to any entrepreneur, because the entrepreneur always is in sell mode. The capital markets are always just a little bit wary or suspicious or eager, but there's this opposite side of the table dynamic going on. You look at these people as peers, be it a big peer or a little peer, or however it works out, and you probably know way more what's going on with them than anybody else. So the first role of the lead is to help identify those candidates which are in best alignment with the company. This is work. This is business development work. This is continuous business development work. I must spend 20 to 25% of my time working with angel groups, individual angels, strategics, and venture firms, and this is why we joined NVCA. It wasn't to become a venture firm. It was to get greater access to sort of what was going on inside, which partner was in, which partner was out, rub shoulders over cocktail hour. Where are you in the life of the fund? How much capital do you have left? Oh, do you have LP problems? Really? All those dynamics that go on to say whether or not I pick up the phone and say, hey, this is a deal we should do, and by the way, you are my first call, and I really want you to do it. If it doesn't work for you, tell me a quick no. Two is knowing that alignment of interests. And three, and very much important along the lines of this, is having long-term relationships that are multifaceted. My first graduate degree was in quantitative game theory, and pardon the technical description here, but the only stable, non-cooperative, multi-round game is tit for tat. In other words, if we have a lot of business together, multi-round, and I screw you, you'll screw me back, and I'll learn my lesson. And I do something good for you, you'll do something good for me. And it stabilizes. And that's it, whether it's arms control or investing. And if you don't have multiple things to work on, that pattern never establishes itself. And that's when people often get screwed. It's like buying a used car. You drive off the lot and like, hey, I got you or you got me, game over. The idea is to have this go on, so multiple deals. That's why I think running off to you know, brand name investors you've never dealt with or a one-off is not a particularly good recipe. So the role of the lead plays in all three of those things, and it's really worked for us.